Hello everyone, I am going to talk about national income, its related concept and estimation. I am Nilendu Chatterjee from Department of Economics, Bankim Chandra College. As you all know, national income is one of the most important chapters of macroeconomics which you are going to study in your macroeconomic syllabus. Now, national income is quite a huge chapter, so for the sake of simplicity, I have divided the entire chapter into 3 video lectures. So you will be having 3 video lectures and their related study materials, as well as few practice materials which you can call case studies and few related questions. So first we are going to study about different definitions or concepts of national income in this video, and second video will be about its different methods of estimation, and the last video will be dealing about problems of measuring national income and few latest concepts of national income. Now, what is national income? What is national income? Now, national income, as we all know, national income is the income earned by all the residents of a nation by taking part in production activities or productive activities, you can say. Hence, it's the money value of the goods and services which are produced by any nation during an accounting year. So, it consists of the collection of different categories of goods and services. Why? Because a nation generally has, or in economics we say there are 3 economic sectors, that is primary, secondary and tertiary or service sector. But we cannot add up the production of these 3 units because they are expressed in different units. So we convert them into their monetary values and add up them to get the value of national income. Now, one more thing to be noticed here is during an accounting year. Now, every nation has its own accounting year. For India, it is April to next year's March. So when we are talking about 2020-21, it is 2020's April to 2021's March. That refers to the accounting year of 2020. So within this period, the money value of all the goods and services coming from all the 3 sectors are to be calculated or taken together to get the value of national income. Now, in this video, our focus areas will be, what will be our focus areas in this video? Our focus areas will be gross domestic product at market price, at factor cost, and at current price, at fixed price, gross national product, NDP or net domestic product, NNP net national product, NNP at factor cost, PI or personal income, PDI or personal disposable income, and nominal GDP and real GDP. You can see there in NNP at factor cost, it is also known as national income. Why it is so, we'll come to that later on. First, we are going through different GDP and its different concepts. Now, GDP is the money value of all the goods and services. GDP is the money value of all the final goods and services which are produced within the domestic boundary of a nation within an accounting year. Now, few things are to be noticed here, that we allow or we consider the final goods and services here, and domestic boundary. That means for India, when we are talking about GDP, we have to consider the goods and services produced within the Indian economy or within its map, within its domestic boundary, within the account, and also within the accounting year just taught earlier. Now, when GDP is measured on the basis of present or prevailing prices, it is known as GDP at current price. That means when in the year 2020, when you are measuring 2020's GDP, that is known as current price. But if we measure 2020's GDP based on 2005's price, that has to be known as GDP at fixed price or GDP at constant price. In that case, 2005 will be referred as base value or the base year. So GDP is the money value of all final goods and services that is produced within the domestic boundary of a nation within an accounting year. And again, when it is measured on the basis of present year's price or current prices, it is known as GDP at current price. When it is measured at constant or based on the base year's price, it is known as GDP at fixed price. Now, we all know GDP at market price. That means the market value of all the goods and services are to be considered together. Now, from market price, when we deduct indirect taxes and we add subsidies, we get GDP at factor cost. So, GDP at factor cost means the total net value that is added by different production units or different producing units as well as the consumption of fixed capital. We know there are 4 factors of production. So, GDP at factor cost measures the net value added by all of them as well as the consumption of fixed capital. And the formula for arriving at that is we have to deduct indirect tax and add subsidy to GDP at market price. Next, we are going to talk about real GDP, nominal GDP, and GDP deflator. Now, estimation of gross domestic product does not take into account the inflation or change in prices. So, if price doubles, it will appear that GDP has doubled, but it may not be so. Output may not have doubled. So, it will not give us a true picture of the economy. So, when GDP is adjusted for the price level or GDP is adjusted for the inflation, what we get is real GDP. So, real GDP gives us the actual value for the level of output, and real GDP is obtained by using GDP deflator. So, when nominal GDP is divided by GDP deflator and then multiplied with 100, we get real GDP. And GDP deflated is also the ratio of nominal GDP and real GDP, and then we have to multiply it by 100. So what does GDP deflator show? It shows the level of change in the GDP which is dependent on the price change, because it shows the change in the level of GDP due to the change in price. Next, we are coming to NDP. Now, NDP means depreciation has to be deducted from GDP, because GDP does not take into account any depreciation. So when we deduct depreciation from GDP, we get net domestic product. Here we are going to talk about gross national product and net national product, or GNP and NNP. Now we know that GDP is the sum of the money value of all final goods and services that is produced within the domestic boundary of a nation. Now with GDP, when you are adding net factor income from abroad, we get GNP or gross national product. Now what is net factor income from abroad? Suppose we are giving example of India. So for India, net factor income from abroad would imply the income earned by Indian residents from a foreign nation by taking part in economic and productive activities, minus income earned by foreigners by taking part in economic activities in India. So national net factor income from abroad could be positive or negative. So it decides whether GNP is greater than or less than GDP. So net factor income from abroad, if it is positive, that means Indians are earning more than the foreigners are earning in India, and if it is negative, it would imply the opposite. So NFIA, or net factor income from abroad, has strong implication in deciding whether GNP is higher or lower than GDP. Now we know that the closed economies do not take part in international trade or international activities. For them, GNP would be equal to GDP. Now coming to NNP, or net national product, it is obtained just like NDP, because NDP was obtained by subtracting depreciation cost from GDP. NNP can be similarly found by subtracting depreciation cost from GNP. And again, NNP can also be obtained by adding net factor income from abroad with NDP. So hence, here also net factor income from abroad decides whether NNP is greater than, equal to, or less than NDP. So net factor income from abroad has a good role to play in deciding the values of GNP and NNP of a nation. Now coming to NNP at factor cost, it is also regarded as the national income, or the proper definition of national income. Why? Because NNP includes GNP, and we know GNP includes GDP. So it includes the entire range of production that takes place within the domestic economy, as well as includes the income earned from abroad by net factor income from earned from abroad. And it also deducts the depreciation cost from it, because it gives us the actual value or the actual amount of output that is accruing to the factors of production, actual earning that is accruing to the factors of production. So from NNP at market price, when we are subtracting indirect tax and adding subsidies, we are getting NNP at factor cost. So NNP at factor cost gives us the actual level or actual concept of national income, because it gives us an idea about the entire range of production that takes place within an economy, as well as the net factor income earned from abroad by the residents of that nation. Now we are moving to personal income and personal disposable income. Now personal income is generally regarded as the income earned by individuals from all possible sources. Now we know individual takes part in different productive activities, or he or she can earn from dividends, from corporate profits, from shares and bonds. He or she can earn from transfer receipts of the government. One has to contribute for the social security purpose. All these things will be considered before we arrive at the definition of personal income from national income. Now, the formula regarding personal income will be given in the next video, or will be discussed in the next video. For now, we can say that we have to consider, or we have to add all these earnings together, and we have to subtract few earnings as well from national income to get to the value of personal income. So national income is not equal to personal income. Now, what is personal disposable income? From personal income, we have to deduct direct tax as well as we non-tax payments. What are the non-tax payments? Now, non-tax payments, suppose an example of non-tax payment is license fees. So when we deduct these things from personal income, we get the value of personal disposable income. That is what is left in our hand actually to spend for the consumption purpose as well as for the saving purpose. We can use personal disposable income for two purposes. One is personal outlay, that is for the consumption purpose, and another is for the personal saving purpose. For this part of the video, I have referred Professor Soumen Sikdar's book, that is Principles of Macroeconomics. You have to study chapter 2 from that book, and along with this video you will find a study material as well, and two more related videos, that is known as supplementary videos, study material related to this video, and there will be a case study and few questions to solve from this video. Thank you very much. See you in the next video.